What's up, YouTube? In this video today, we're going to be talking about $50 and how to start investing with just $50. That's all we're talking about in today's video. Not 4 digits, not 3 digits, just 2 digits, 50 bucks. The same amount you spend on takeout without batting an eye. The same amount that disappears from your wallet, and most times you genuinely have no idea where it went. Because here's what most people think of investing looks like. A bunch of guys suited and booted on Wall Street, screens full of flickering numbers, millions of dollars moving about. But here's what investing actually looks like in 2026. Just you, your phone, $50 and peace. That's it. No suit required. No Wall Street connections needed. No finance degree necessary. Just $50 and the profound decision to start. Today we're going to talk about exactly how. It doesn't matter if you're 18 just starting out, perhaps you're 35 feeling a little bit behind, or maybe 55 thinking it's way too late. It's not. First off, here's why $50 is more powerful than you think. In today's economy, it doesn't feel like much. You get a couple groceries, it's gone. You need some gas, that $50 is out of here. A decent dinner out, don't even think about it unless you're going solo. But what if it's invested? Then $50 becomes something completely different. Let's do a little math, and hopefully you'll put down that takeout menu. $50 invested monthly with the average stock market return of an estimated 10% annually, starting at age 25, by quote-unquote retirement age of 65, $50 a month has turned into well over $300,000, around $318,000. Yep, $318,000 for $50 a month isn't bad, all things considered. $50. The combined cost of your Netflix, Hulu, and maybe that gym membership you forgot to cancel. Okay. All right. I know what you're probably thinking. That's great, but what if I'm not 25? That's a fair question. Starting at 35, you'd have approximately $113,000. Once again, not bad from just 50 bucks a month. Starting at 45, close to $40,000. And if you're starting at 55, it's still a little bit more than $10,000, more than you have doing absolutely nothing. And remember, we're talking about $50 here. You can easily raise that amount to your affordability level or lower it. Just get started. Every age listed wins, and every single age in between, because the best time to start was yesterday. The second best time will be right after this video ends. All right, so now, where do you put your $50? Let's look at some real options in today's market, because there are more than ever before, and most of them fit right in your pocket, right on your mobile device. So, first option, index funds, probably my most recommended. Think of an index fund like a financial buffet. Instead of betting everything on one company, you're spreading your money across hundreds of companies at once. When one goes down, the others go up. It balances itself out over time. Warren Buffett himself recommends index funds for everyday investors. And if it's good enough for the richest investor alive, it's probably good enough for you and your 50 bucks. Index funds are best for everyone. Seriously. Every age, every income. And the minimum requirement to start is as low as $1 on most platforms. But where do you buy index funds? Fidelity, Vanguard, Schwab, all free to open. Personally, use Schwab and Webull. Second best place to put your 50 bucks? Exchange traded funds, or ETFs. ETFs are basically index funds' cooler younger sibling. Same concept, diversified collection of stocks, but they trade like individual stocks throughout the day. More flexible, often lower fees. ETFs are best for people who want flexibility in their investments. Full disclosure, ETFs are a mainstay in my portfolio. You can surely start for $50 with the price of one share. Many of them are under $50 and they pay dividends. Popular options under $50, SCHD, SCHX. Once again, full disclosure, I own both of those. That's just to name a couple. Third option, and this is a good option if you want to start with less than $50 or more, which is fractional shares. I remember there was a time you had to buy a whole share of Amazon or a whole share of Apple. That was like $1 kajillion for one share. That's not exactly beginner friendly. But now, you can buy just $5 worth of Amazon stock, or just $10 worth of Apple stock, or $1 worth of Tesla. Fractional shares let you own pieces of companies that you believe in without needing to be a millionaire first. This is how I got started using Webull investment platform. Finally, democracy comes to Wall Street. Fractional shares are probably best for anyone who wants to own specific companies they love. Can be started with just $1. I think I've even spent like 75 cents on Webull just buying pieces until I ended up with a complete share. You can use Robinhood, Fidelity, Cash App Investing, or Webull, like I mentioned before. The fourth option, a simple high-yield savings account. But remember, technically, this is not investing in a traditional sense. But in today's economy, with a little research, you can find a high-yield savings account that pays 4 to 5% interest. Compare that to your regular bank account paying 1% interest comparatively. Your bank has been paying you almost nothing on your savings for years while quietly making millions off your money. Switch to a high-yield savings account today if that's possible. It's the same as a regular savings account, just, it's actually worth having. Great for building that emergency fund, short-term savings for risk-averse investors. Look into Markets by Goldman Sachs, Ally Bank, SoFi. I personally use Ally for my high-yield savings. The fifth option would be retirement accounts, 401k, IRA. If you work and your job offers a 401k with employer matching and you're not contributing, I say this with complete love and zero judgment. God is my witness. You are leaving free money on the table, but that's a personal choice. Your employer is literally saying, we will match what you put in up to a certain percentage. That's an instant 50 to 100% return on your money that you will never find anywhere else, ever. Great for anyone with an employer who offers matching. That's all age groups. Even starting with as low as 1% of your paycheck is worth starting. It's free money at the end of the day. The IRA option is available if no employer match is available. Open a Roth IRA, $50 to get you rolling. And because one size doesn't fit all, let's break down what to do with your $50 based on where you might be in life. If you're of the age 18 to 25, you have the most powerful asset in investing. TIME. Time. Seriously, time is your investing superpower right now, so embrace it. Your $50 plan, $25 to a Roth IRA that grows tax-free forever, $25 into an index fund or an ETF of your choice. Set it to automatic on a monthly basis. Forget it exists, then thank yourself at 65. You literally cannot mess this up at your age. Easy money. Time fixes almost every investing mistake. Almost. But now if you're 26 to 40, life got expensive, didn't it? Paying rent, kids, maybe, car payments, etc. The fun just never stops. But $50 is still $50. Your plan, if available, Max out any employer 401k match first. Free money, remember? Then $30 index fund. Then $20 high yield savings. Build that emergency fund. Then convert that $20 into an index or an ETF. Consistency beats perfection at this stage. $50 every month beats $500 once. Now, if you're 41 to 55, maybe you're feeling behind. Don't. The beat goes on, and so does life. Maybe you're looking at retirement and starting to feel that panic creep in. Use that as motivation to see what can be achieved. Pause, take a breath. You have more time than you think, and creating the habit of investing is what's going to pay off for you. And to put it bluntly, you likely have more earning power than you did at 25. Your $50 plan, $30 to a traditional or a Roth IRA, catch-up contributions are allowed at 50 plus. The other $20, index funds focused on growth. Also, it's worth talking to a financial advisor at this stage. Although it's not necessary, and if you're 55 or over, let me start by saying it is absolutely not too late. Anyone who told you otherwise was wrong. Your $50 plan goes as follows. Focus on lower risk investments, bonds or dividend stocks, high yield savings for liquidity, social security optimization, something often overlooked. Consider a financial advisor for personalized planning. $50 invested today still beats $50 spent on something you won't remember next week. Now, as you move throughout this process, there'll be a couple of mistakes you want to avoid. First mistake, trying to pick individual stocks right away. Remember, you are not smarter than the market. I am not smarter than the market. Warren Buffett barely beats the market consistently. Just start with index funds or dividend-paying ETFs. Learn first. Stock pick later if you still have the desire. Mistake 2, panic selling. When the market drops, and the market will go down, that's not a question. Sometimes a lot, like a roller coaster. But remember, 2008 happened, 2020 happened, and more will happen. But the people who lost money were the ones who sold in panic. The people who won stayed in and kept buying. Your investments going down temporarily is not a loss. For the sake of God, please understand that statement. Your investments going down temporarily is not a loss. It's a sale. Just like spending money on liabilities, TVs, electronics, etc. When the price drops at Walmart, you hurry and buy. Except these are assets that you pay for, and they pay you. Mistake number 3, waiting for the right time to invest. I covered this last week. There is no right time. There is only now time. Mistake number 4, keeping all your money in one place. Don't put everything in one stock. Don't put everything in crypto. Don't put everything anywhere. Diversify. The boring answer is almost always the right answer in investing. Mistake number 5, not starting because $50 feels too small. I started this video talking about $50, and I'm going to end this video the same way. $50 is not too small. $50 is just the beginning. In today's economy, everything feels expensive. Everything feels uncertain. And honestly, that's exactly why starting matters more, not less. Because the people who build wealth during uncertain times are the ones who don't let uncertainty stop them. They start small, they stay consistent, they ignore the noise, and they keep going. You have $50, you have a phone, you have this video, you have everything you need to start today. Not perfectly, not with all the answers, but you can start. So open that app, transfer that $50, and join the millions of everyday people quietly building wealth while everyone else waits for that perfect moment. This is SOTS Financial, practical finance for real people. Like, comment, subscribe, and I'll see you in the next video. Peace be with you.